Billionaire author of Rich Dad, Poor Dad, Robert Kiyosaki taught me these 4 key lessons that have made me tens of millions of dollars through my property investing. And in this video, I'm going to run you through those 4 lessons and exactly how you can implement them into your property investing strategy to make millions and millions of dollars. So let's jump into it. The 4 lessons that I got from Robert Kiyosaki is the difference between an asset and a liability, and how one will make you extremely wealthy and the other will make you poor, and how you can actually pay for your liabilities with your assets. Now, the second lesson that I learned from Robert Kiyosaki is that cash flow is king, but capital growth is God when you are starting out on your journey and you don't have a lot of money to work with. The third lesson I learned from Robert Kiyosaki is how debt is not a bad thing. It is actually the thing that will make you stupidly rich if you use it in the right way. And the fourth thing that I got from Robert Kiyosaki is that 99% of building a significant amount of wealth isn't about the things that you do on a daily basis, but it's the things that you think about on a daily basis and how you can actually build a mindset to create extreme wealth. So let's dive into lesson number 1, which is the difference between an asset and a liability, and why buying assets first will actually allow you to buy a stupid amount of liabilities because your assets will pay for them. When I was 18, I bought my first asset, which was a 2-bedroom apartment in the Sydney suburb of Coogee, and I paid $720,000 for that property. That was almost 10 years ago. I bought that property when I was 18, and at the point of recording this video, I'm 28 years old, and that property has almost doubled in value, which essentially means it's gone from being worth $720,000 to now being worth almost $1.5 million, which essentially means it's made me $60,000 to $70,000 per year over the last 10 years. If I did not buy any more assets on top of that first property, and for people who don't know, I've now got a portfolio which is almost $40 million. But if I didn't buy any more real estate, essentially my worst case scenario would be that that property has made me 700 grand. I could have spent 100% of that $700,000 that property has made me on liabilities, being cars and holidays, all of those things that we go out and spend money on that actually depreciate or diminish in value. I could have spent all of the growth on those things, and I'd essentially be in no worse of a position because my asset has paid for those liabilities, as opposed to me having to go to work every single day, earn my money, and then use my earned income to pay for those liabilities, which is what most people do. And I was fortunate because not only did Robert Kiyosaki teach me this lesson, but another one of my mentors, Chris Gray, also taught me this lesson. He said, Jack, if you want to go out there and buy the cars and go on the holidays and do the extravagant things, buy the jewelry and all the rest of it, which I don't actually do, but he said, if you want to do that, you can do all of that and more. You just need to make sure that you don't pay for it with your earned income, which is money that you go to trade your time for. You pay for it out of the growth and the cash flow that your assets give you. Now, there are many different shapes and sizes and forms of assets. I've chosen to go down the property or real estate investment, and the reason that we do that, especially in Australia, is because you generally need a very small amount of money to start. You know, if you're a first-time investor, you can sometimes get into the marketplace with a 5% deposit, and you pay no stamp duty and no lender's mortgage insurance, and you then get control of a much larger asset base. You essentially get control of an asset base which is 20 times larger than the initial cash that you put into the properties. Meaning if you put $50,000 into a property, you can potentially buy something for $1 million. Now, the awesome thing about that is you then get growth on that $1 million asset, and hypothetically speaking, that $1 million asset grows by 5%. It's grown by now $50,000, which essentially means the $50,000 that you've put in, you've just created another $50,000 because the $1 million asset has grown by 5%, which then is 100% return on your initial $50,000 investment. That's the awesome thing about real estate. Whereas if you invested into shares, for example, you're invested in, crypto, to get that same $50,000 return, the asset that you invest in has to double in value because you're not taking on any leverage. So that's why I chose to go down the real estate path. Now, because of that, we also need to make sure that we protect this thing called borrowing capacity, which is essentially how much money the banks will lend us. And this is another really key lesson that I learned about not going into liabilities before buying assets. Because essentially, if you go out there, you go to a bank and you get a credit card, for example, or you go and get a car loan and go and buy that new car, or you go and get a loan to go on that holiday, or whatever it is, all of those things are classed as liabilities because they don't put money in your pocket, they take money out of your pocket, and all of them will actually decrease your borrowing capacity. So when you go to buy assets, the bank will go, sorry, Jack, you've got a credit card, you've got a car loan, you've got a personal loan for a holiday, and because you've got all those things, we would have lent you $800,000 to go and buy a property, but because you've now got these liabilities against your name, we'll only lend you $300,000, which essentially means you potentially left $500,000 of borrowing capacity on the table because you went and got liabilities before you bought assets, and that $500,000 of borrowing capacity could be worth many, 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 many millions of dollars down the track. So the key lesson that's been reinforced for me is that because I bought the asset first as opposed to the liability first, that asset then increased in value, and I could actually use the equity, which is the difference between the mortgage on the property and the value of the property, and then I could use that equity to go and pay for my liabilities. And because you aren't going to get a car loan and you aren't going to get a personal loan and you're not getting a credit card, but you're simply using equity from the property, it has a much lower impact on your borrowing capacity because the debt is actually secured against an asset being real estate, as opposed to getting debt, which is personal or credit cards or whatever it is, which actually has no security. It's unsecuritized, so you pay a significant interest rate on that. And the difference between asset-backed debt versus non-asset-backed debt is 6% or 6.5% for asset-backed debt versus 20% or 25% for something like a credit card, for example, which there's no asset backing it. So that is a really key thing that I learned, is that if you want to buy the liabilities, buy them with the assets as opposed to just going out there and buying them with your earned income, and you will be significantly wealthier over time. And that's what's allowed me to scale my property portfolio from that one property back when I was 18 to now 15 properties at 28. Now, the second lesson that I learned from Robert Kiyosaki and Rich Dad Poor Dad is that cash flow is definitely king. There's no doubt about it. But you can't generate the cash flow without having capital to be able to generate it from. And that's why growth is God and cash flow is king. Now, what I mean by that is a lot of people, when they start out on their investing journey, they go and buy their assets. What they're focusing on in the early day is, if I put $1 into this, how much am I then going to get back every week or month or year from cash flow? The unfortunate reality is generally when people start investing, they have little to no money. And the first thing they need to do is build the money that they have. So if they start off with a $50,000 deposit, for example, for a property, if you went and invested that $50,000 to just get cash flow and you got, say, a 5% return or a 5% yield on that money, you would get $2,500 per year, or $50 per week, of which you would obviously then pay tax on. Now, I'm not sure about you, but for me, $2,500 a year on a $50,000 investment doesn't really get my heart singing. It's not really going to pay for much, if anything, in my life. But instead of investing $50,000, if I could go and invest $500,000 or $5 million, and then I got 5% on that amount of capital, the cash flow that it would generate would be significantly different. I mean, 5% on $500,000 is $25,000 a year, and then 5% on $5 million is $250,000 a year from a cash flow point of view. So what you can see is cash flow is king. There's no doubt about it, because we need cash flow to live and retire and have passive income and do what we want to do and pay for those liabilities like I mentioned before. But we can't get the cash flow if we don't have the capital to be able to generate it. Now, a good rule of thumb is for every $1 million of capital that we have, so think about $1 million of cash sitting in your bank account, for every $1 million we have, we can generate around about $50,000 a year from a cash flow point of view, and we wouldn't eat down on our capital, meaning that the next year we wouldn't have $900,000 and the year after that we wouldn't have $800,000. The $1 million would remain the same and potentially grow by a little bit, and we'd also get then the dividends or the cash flow coming off that. So if you're starting your journey today and you're going, okay, how can I invest my money or how can I invest my capital to go and get cash flow so I don't have to work? Unfortunately, you're going to be let down because you don't have enough capital to be able to generate it. So the focus for me, before I worried about cash flow, was to go, well, if I've got 50 grand that I'm starting with, how can I turn that 50 into 100? And if I can turn it into 100, how do I turn that 100 into a million? And then if I've got a million, how do I turn that million into 10 million? Because the larger the amount of money or capital you control, the larger the cash flow dividend will be on that money. That helped me develop my property investment strategy into the Flamingo investment strategy, which is what we call it. And essentially, we start our journey in this phase called accumulation, which is essentially we don't have any assets, we don't have much money, so now we need to go through and accumulate. Once we accumulate more assets, so we might go and buy one property. After a few years, you might, use the equity out of that first property, then get into our second property. A few more years down the track, you might go from 2 to 3, and all of a sudden you start to get the snowball effect. You still don't have a huge amount of capital, and the reason for that is because as soon as you get equity in one property or capital, you roll that into the next property. So it's not like you're becoming rich, you're becoming asset rich, and you've probably heard that saying before, asset rich, cash poor. In this phase of the investment journey, we're becoming asset rich. Then we go through this phase called acceleration, which is we've now got some assets, we've now got a little bit of capital. How do we make our current assets and current capital worth more money? So through residential real estate and property investing, we go through and we add value to those properties through things like renovations, through development, through potentially adding second dwellings and granny flats. That's how we add value to the properties without just the natural market growth. Okay, so now we've accelerated the portfolio. Then we go through this phase called incubation, which is essentially the actual point where you make the most amount of money. Because essentially, let's say we have $2 million worth of assets and we've got $1.5 million worth of debt. Our equity position or capital position is $500,000. Now, let's say that over a 10-year period, all we do is hold those properties. Just simply hold them and let the marketplace grow them. Over a 10-year period, if they grow at 7% per annum, they're going to go from being worth $2 million to being worth $4 million over that 10-year period. Remember, our debt on that originally was $1.5 million. And if we assume that we didn't pay off any more debt, we just kept the debt level the same, we paid interest only, we'd still have $1.5 million. But what has now happened, because our property portfolio has gone from being worth $2 million to $4 million, we've now taken our capital from being $500,000, which was the gap between our mortgage and the value, to now being worth $4 million. So my gap now is from 1.5 million to 4 million, which means we've taken our $500,000 worth of capital to now $2.5 million. So now our portfolio value has doubled during the incubation phase, but our equity or our capital position has 5x'd because it's gone from 500 to 2.5 million. And remember what I said before about the more capital we have, the more cash flow we have. So if we would have sold our properties before that incubation period and taken our 500,000 off the table, we'd be able to generate 25 grand in income. Now we've left it in the market for another 10 years and we've got 2.5 million. That 5% return on 2.5 million means we've got 125,000 worth of income. So that incubation period is actually where you make all the money. And then we go through this period, which we call consolidation and evolution. And consolidation is that sell down where we sell down the properties, we pay off our debt and we're left with that capital or that cash. And the evolution is when we then invest it to generate our cash flow so we can then go and retire, enjoy our life, generate passive income and do the things that we love, which is that cash flow phase of our journey. But we could not get there without the growth. And that's why I say, and Robert Kiyosaki taught me, that growth is God, because without it, there is no cash flow. You essentially think about God and the king. Without God, there is no king. And that's what we have to remember here. So before we try and generate cash flow, we need to have enough money to generate enough cash flow for us to be able to enjoy our life. And a really good rule of thumb, like I said, is for every 1 million of assets that we generate, we're going to get about $50,000 of income, $500,000, $25,000 of income. So a 5% net return. Now, the third lesson that I got from Robert Kiyosaki, and it's actually the title of the book, Rich Dad, Poor Dad. Now, what that comes down to is overall mindset, because Robert Kiyosaki's Rich Dad taught Robert about money. He taught Robert the difference between income and expenses. And he taught Robert how to actually think about money. Where Robert's poor dad, it was always about how much can we save? Don't spend money on that. You know, we don't talk about money because money is a sour topic and we should be very private about those things. And essentially the difference between the two, rich dad is open to talking about money. He's open to teaching about money. And he's probably also open to learning about money because there's things that rich dad probably doesn't know. Where poor dad, because he's probably illiterate with money, he doesn't like talking about it. He's not open with his financial situation. He's probably closed off when people start to talk about it, so he won't learn. And really the difference between those two is just a mindset piece. So having a money mindset and actually having a rich dad mindset is one of the biggest things that has made me the money that I've been able to make and has separated me from 99.9% of people. Now, I don't claim to know everything. I actually know very little in comparison to so many people, but I know that I don't know lots. So I'm open to learning all the things that I don't know. And with the things that I do know, I'm teaching people what I've learned and the experiences that I've gone through so they can learn as well. Hence the reason I'm doing videos like this. So the key is to have a rich dad mindset and always be open to learning, because the more you learn, the more you earn. Now, I've actually gone through and been very clear about what a poor dad mindset is. And if you think about a poor dad mindset, to have a rich dad mindset, you just have to have the opposite of these things and your life will become a lot better. And I've actually called it the 7 deadly sins of poor people. And essentially it is the 7 things that most poor people have, and it's the reason that they are poor. Now, poor is obviously a very offensive word to some people, but the way that I think about poor is it's someone's mindset. They think poorly, and that's what holds them back. The first sin in the 7 deadly sins of poor people is they have too much pride. They think they're too good, they think they know too much, and they're not open to taking on any help, which keeps them stuck where they are. Now, the opposite of pride, if you want to have a rich dad mindset, is being humble and knowing that you don't know a lot and there's so much more to learn, and that if someone is making lots of money and they've got the life that you want, don't have too much pride to not learn from them. Go be humble, ask questions and learn. And that's exactly what I did. I knew nothing about money and I wanted to learn more about money. So I went to the seminars, I put my hand up, I made myself uncomfortable in asking questions, and I wanted to look stupid in front of lots of people, which lots of people won't do, but it's the thing that allows you to continue to learn. And like I said before, the more you learn, the more you earn. So you need to make sure you don't have too much pride to be able to learn. Now, the second sin is lust and having too much lust. Lust comes down to not having any impulse control. I told you a story before about buying my first property, that now being worth almost double what I paid for it and being able to then pay for the liabilities with that asset. Impulse control is going, well, instead of using the cash that I had to go and buy a car, to go and buy a holiday, to go and buy whatever I wanted, it was to not do that and control the impulse and to actually put that money into an asset. So impulse control is knowing that you need to control what you want to do for what you need to do. That is the most important thing. So if you think about a poor person, they have no impulse control. They go and buy everything they want. They go and get the afterpays of the world and spend money that they don't have. And I like the term, they try and look rich when they aren't rich. Where people who can control their impulse go, I don't need that right now. And I know if I do X, Y, and Z and go and invest my money, that will then get me the things that I want with the asset. You need to make sure that you have enough impulse control to start to build your capital base, to start to get momentum. And then when you've got more money, you still need impulse control, but you need less of it because you obviously have money that's coming in from your assets. The third sin is essentially gluttony. And what I mean by gluttony is you're a consumer and you're not an investor. So you just get out there, it's all about consuming. You know, gluttony can be with food, it can be with shopping, it can be with lots of things. But essentially, we want to make sure that we are not consumers, we are investors. If you would have invested the money that you've spent on buying a new iPhone every year into actually buying Apple stock, your iPhones are worth negative X amount of dollars of what you paid for them, and the Apple stock that you could have bought is worth tens of millions of dollars. And essentially what that shows you is instead of using the money to go and consume and buy what Apple produces, why don't you use that same amount of money and go and invest in the company that Apple is and then get a return on that, which can then pay for all the iPhones in the world. So gluttony is being a consumer and not an investor. And if you're an investor, like I said already in this video, the investments will pay for your ability to go and buy whatever the fuck that you want. The fourth sin is greed. And essentially, as you start to make money, you're greedy with it, you don't want to share it with anyone else, and you don't understand the fundamental, which is the more money that you make other people, the more money you will make yourself, where greed is the opposite. It's just more for me and nothing for anyone else. And that only gets you so far. And often what you see with poor people and the poor mindset is they aren't open to sharing. They aren't open to philanthropy and giving away their money because they think, well, I've got this amount of money and I want to keep it for myself. If I make more money, then I'll start giving it away and being more free with it. But the reality is, if you aren't free and generous with your money when you have little, when you have a lot, you're just going to become more and more greedy. And Tony Robbins talks about this all the time, where he says, if you won't give 10 cents out of $100, why are you going to give $10 out of 100 million? We need to make sure that we're not greedy. We're free and open with our information. We're free and open with our money. We're free and open with anything that we can be, because the more we can do for other people, the more those people will do for us. And if you're just thinking about it through a money sense, the more money you can make someone else, the more money you're going to make yourself in the end, because you're delivering value. The fifth sin is essentially sloth, which is low motivation, low energy, low commitment, saying you're going to do things and not doing them. And that is a common trait amongst poor people. They say they're going to do things, they don't do it. They reinforce their ability not to do things. How can you go and make a lot of money and go and be successful if you can't even do simple things like work on your exercise, work on your health, for example? That's a really common one we see, is that often poor people are lazy people and they blame the world for their problems, when the reality is that they took a little bit of self-responsibility and had a little bit more respect for themselves and they got the basics right, that then flows into all other areas of your life and you become a lot more successful, not just from a financial point of view, but all other areas. The sixth sin is wrath, which is essentially having low emotional intelligence, not being able to control your emotions. And often you'll see that, people with a poor mindset, they get angry, they lash out, they blame a lot of people for their own issues. It gets you nowhere in life, and it often gets you much further away from success than it does get you closer to success. And you see this a lot in politics. Politics are very good at pointing the finger at everyone else, and it's that person's fault for this. That then flows into individual life, and they go, well, it's the politician's fault, the reason that I'm in this situation. When the reality is, if you were responsible, you had emotional intelligence to understand, well, my life is the way it is because of me and no one else. And if I have that mindset, that means that my life can be amazing because of the things that I do as well. Again, you'll go much further in life. And number 6 actually ties in now to number 7. And the 7th sin is envy. Poor people often look at rich people and go, money's the root of all evil. He's only or she's only rich because they rip people off. And they're just envious of the life that they have, as opposed to being inspired to want to learn from those people to create that life for themselves. So that for me summarizes the difference between a poor person's mindset and a rich person's mindset, or a poor dad mindset and a rich dad mindset. It's essentially just full accountability and taking full action to own your financial situation, and having the mindset to be constantly learning, constantly investing, and constantly knowing that you don't know everything. And the fourth and last lesson that I got from Robert Kiyosaki, who is the author of Rich Dad, Poor Dad, is that debt is only bad if you buy bad things with it. Now, when most people grow up, I know including myself, you always hear the term, get out of debt, don't have debt, it's bad, you'll go bankrupt and all the rest of it. But then you look at some of the largest companies and the most wealthy people in the world, and they just carry a huge amount of debt. And you go, well, if debt is bad, then why do the wealthiest people in the world carry so much of it? But what we're often not taught, and the lesson that I got from Robert Kiyosaki, is that debt is not created equally. You have good debt and you have bad debt. The difference between good debt and bad debt, you're going to find this probably interesting, is that bad debt is tied to bad things like liabilities, right? So if you've got debt like credit cards or personal loans, etc., for things that don't appreciate in value, they depreciate in value, you don't get tax benefits out of them, that is bad debt, and that's the debt you should run the other direction from. Whereas good debt is tied to assets, and assets are things that appreciate in value. They're things that the government gives us tax concessions on, and it's debt that often devalues over time. And what I mean by devalues over time is that as asset values get more expensive, the same level of debt becomes less relative. And if I use the example before, where I ran you through the incubation phase of our property investment strategy, you think about we had $1.5 million of debt, which was tied to $2 million worth of assets, and we had $500,000 worth of equity. Now, we still had $1.5 million worth of debt 10 years later, but the asset value was no longer 2 million, it was 4 million. And all of a sudden, that $1.5 million of debt doesn't seem so relative anymore because the assets that it's tied to are $4 million, which essentially means it's less than 50% of the value is debt. Whereas 10 years prior, when it was $1.5 million of $2 million worth of assets, 75% of your asset value was tied to debt. So over time, if the debt is tied to assets and those assets appreciate in value, even if you don't pay any of the debt off, it just becomes less and less relative. And that's essentially because of a multitude of reasons. As the governments print more money, asset values inflate, which means your debt level deflates. And there's lots of reasons for it. But essentially, all you need to know, and all I got from Robert Kiyosaki, is debt is not created equally. And the way to know whether it's a good debt or a bad debt is to go, well, is the debt tied to something which increases in value, which generates me money, which gets tax concessions, or is the debt tied to something that costs me money, decreases in value over time, like a car, for example, doesn't give me any tax concessions, and is actually a liability on my personal balance sheet. And that's one of the really big things that I got from Robert Kiyosaki and an early mentor, like I mentioned before, Chris Gray, is that if you use debt to your advantage over time, it will make you significantly wealthier as opposed to running away from debt because of that wives' tale around, debt is bad, where if you run from debt, you have no debt and you're just trying to use your earned income, which is the money that you go and trade your time for in your job, it's going to take you a lot longer to get wealthy, where if you use debt, it's going to expedite your journey to get wealthy significantly faster. So just to recap, the 4 big takeaways from Robert Kiyosaki's Rich Dad Poor Dad that I've implemented into my own life to build my almost $40 million property portfolio is that assets are the thing you need to buy before you buy liabilities, and they will end up paying for your liabilities. You need to generate capital or growth before you can generate cash flow, and that's why growth is God and cash flow is king. If you don't have the right mindset around money and around growing your wealth, then you are on a one-way ticket to essentially having no money, even if you make it in the short term. Often, if you keep those old money beliefs, you will lose it just as fast as you have made it. And you need to use debt to get rich over time because you get to control much larger asset bases when you use debt as opposed to not using debt. And obviously, as you get growth on a larger asset base, it makes you significantly wealthier. But the real big key takeaway, and the thing that actually makes the most amount of difference on top of all of these lessons, is that if you don't actually take action on them and learn the lesson and then go and implement it, it's just mental masturbation. It's just you learning, and by learning you feel like you're doing something when the reality is you're not doing anything if you don't implement it. So the key thing that I did once I learned this stuff from Robert Kiyosaki is go, how can I now use this to go and make my life better? So we know now that assets are king. What can you buy as an asset? How can you start investing and actually growing your wealth so you can pay for your liabilities? That's the first thing. Second thing is understanding if you've got a certain amount of cash right now, how do I grow that with my assets so I can generate more money? And like I said, $1 million worth of assets get you $50,000 or thereabouts of cash flow. So how can I create a larger asset base, a larger capital base to then get that cash flow so I can enjoy my life more? You need to keep having the money mindset, thinking bigger, learning bigger things, being surrounded by people who are doing more than you. And again, implementing the things that you're learning. That's the biggest thing with mindset, is actually doing the doing, not just learning. And the last thing is understanding how debt works. So learning, watching videos like this, speaking to people, having a good mortgage broker on your side to educate you on debt and how you can use it to your advantage to grow a significant amount of wealth. Now, if you want to learn more about this and actually learn exactly how I've used all these lessons from Robert Kiyosaki to build my almost $40 million property portfolio over the last 10 years. I've got a video right here where I run through the exact strategy that I've used, how I've purchased every property, how we go through the accumulation, the acceleration, the incubation, the consolidation, and the evolution phase of the property investment journey, and exactly how you can do the same thing. So click the video here, go and watch, and I'd love to hear and see your comments on your thoughts on these videos.